So I want to talk about something that I think most people misunderstand about building wealth. They treat it like it's a single continuous journey. Like you just start investing and then gradually you get richer in a smooth, predictable line until eventually you're wealthy. But that's not how it actually works. Building wealth has distinct stages, and each stage feels completely different from the last. Different challenges, different psychological experiences, different decisions that matter most, different things that can derail you. And here's the thing that really matters about understanding these stages. Most people never make it past the first one. Not because the first stage is the hardest mathematically. The math actually gets harder in later stages in terms of the absolute dollars required, but the first stage is the hardest psychologically. It's the stage where the results don't match the effort, where the progress feels invisible, where every reason to stop feels more compelling than every reason to keep going. And without understanding what stage you're in and what that stage actually demands from you, without knowing what the experience is supposed to feel like and why, most people interpret the discomfort of stage one as a signal that something is wrong, that the strategy isn't working, that this isn't for them, and they stop. So this video is about the 4 stages, what they look like, what they feel like, what they demand, what trips people up at each one, and how to make sure you're not the person who spends their entire financial life stuck in stage one. Let's go through them. Okay, so stage one is where everyone starts and where most people stay longer than they should. The defining characteristic of stage one is that nothing feels like it's working. And that feeling is not entirely wrong. In stage one, you are doing most of the work, and the math is not yet doing much to help you. You are the engine and the engine alone. Let me show you what I mean. At $10,000 invested earning 10% annually, you're generating $1,000 a year in returns, which sounds okay in isolation, but you're probably contributing $400 or $500 a month. So the market is contributing about $80 a month, and you're contributing $400 to $500 a month. Your contributions are doing 5 or 6 times more work than the market is. At $20,000 invested, the market is generating $2,000 a year, or about $167 a month. You're still doing more work than the market is. The entire stage one experience is characterized by this imbalance. You're putting in significant effort and the math isn't reciprocating in a visible, meaningful way yet. And the psychological experience of this is genuinely difficult. You budget carefully. You resist spending money on things you want. You automate the contributions. You check the balance, and the balance moves, but slowly, incrementally, not in the dramatic way that would feel proportional to the sacrifice. This is the stage where the overwhelming majority of people who ever start investing quit. Not because anything went wrong, because nothing exciting happened fast enough to sustain the motivation through the boring stretches. What stage one actually demands from you. Stage one doesn't demand sophisticated investing knowledge. It doesn't demand a high income or a large starting amount. What it demands is one thing, almost exclusively: behavior. The habit of investing consistently, month after month, regardless of how small the balance feels, regardless of what the market is doing, regardless of how much faster it seems like other people are getting ahead. The entire job in stage one is building the habit and protecting it, automating it so it doesn't require willpower every month, creating enough structure that life disruptions don't kill it, and building a genuine understanding of why it works so that the impatience of stage one doesn't convince you to abandon something that is actually working exactly as it should. What kills people in stage one? The biggest killer in stage one is impatience mixed with comparison. You see someone doing something exciting, a stock that doubled, a crypto that went up 10 times, a friend who flipped a house, and your boring index fund went up 11% this year, which sounds completely unimpressive by comparison. And the temptation to abandon the boring strategy for something more exciting, something that feels more proportional to how hard you're working, is genuinely powerful in stage one. But here's what almost everyone who chases excitement in stage one discovers. The exciting opportunity almost always underperforms the boring index fund over any meaningful time horizon. Or it goes horribly wrong. Or it requires so much more time and attention and expertise than advertised that even if the returns are okay, they're not worth the cost. Stay boring in stage one. The boring strategy will feel wrong in stage one. That feeling is part of the process. It doesn't mean anything has gone wrong. Okay, so you made it through stage 1. The habit is established. The balance has grown. You've crossed $25,000. Welcome to stage 2, which is better than stage 1 in meaningful ways, but which has its own very specific challenges. The defining characteristic of stage 2 is that the progress is becoming more visible, but the finish line still feels impossibly far away. The compounding is starting to work in a way you can actually see, but the balance is still small enough that the big milestones, $100,000, $250,000, $1 million, feel almost theoretical. At $50,000 invested, the market is generating roughly $5,000 a year in average returns, which is real money. More than $400 a month in average market growth on top of your contributions. For the first time, your money is doing meaningful work alongside you. Not as much as you are, but meaningful. The second engine is running, even if it's still not as powerful as yours. And there's a psychological shift that happens around here that's worth naming. The investing starts to feel real in a way it didn't in stage 1. The balance is large enough that you think about it differently. You start to make decisions with the portfolio in mind in a way you didn't when it was $8,000 or $12,000. You start to feel like an investor rather than someone who has an investment account. The specific challenge of stage 2. Stage 2 has a very specific threat that stage 1 doesn't have to the same degree. Life. Stage 2 is usually happening in your late 20s and early 30s. And that is the most financially demanding period in most people's lives outside of actual emergencies. Career is getting more serious. Relationships are getting more serious. Housing decisions are getting made. Maybe kids are in the picture or becoming real possibilities. The weddings are happening, your own or everyone around you, which costs money either way. The car needs replacing. The apartment isn't cutting it anymore. And all of these things are real. They're not excuses. They're actual competing demands on the same dollars that you're trying to invest. The temptation, and it feels completely rational in the moment, is to pause investing. Just temporarily, just until this particular pressure eases. But as we've covered extensively in other videos on this channel, temporarily tends to become permanently in a way that's not obvious until years have passed. And the years of compounding you miss during a pause are not recoverable. They're gone. The people who make it through stage 2 without pausing are not the ones whose lives were simpler. They're the ones who found ways to increase income rather than decrease investing, who treated the investment as fixed and found flexibility elsewhere, who built side income or pushed for promotions or moved to higher paying roles specifically so that the investing didn't have to stop. What stage 2 demands? Stage 2 demands resourcefulness, not just discipline. The discipline was the demand of stage 1. Stage 2 demands that you find a way, though through income growth, through creative budgeting, through something, to keep the investing alive through the most financially demanding decade of your life. Because the people who make it through stage 2 with the investing intact arrive at $100,000 with momentum that makes everything that follows dramatically easier. And the people who pause and restart and pause again arrive at $100,000 years behind where they could have been, with a habit that's been interrupted enough times that it feels fragile in a way it wouldn't have if it had never stopped. Okay, this is the stage that changes everything. And I want to be very specific about what changes and why, because I think this is the most underappreciated stage in the entire wealth building journey. The defining characteristic of stage 3 is that for the first time, the math starts doing more of the heavy lifting than at $100,000, the market is generating roughly $10,000 a year. Your monthly contributions might be $500 or $1,000, depending on where you are in your career. The market is now generating between 40% and 80% as much as you're contributing in a given year. At $200,000, the market is generating roughly $20,000 a year. That's more than $1,600 a month in average return, probably more than your monthly contribution at this point. And somewhere between $150,000 and $250,000, depending on your contribution level, the market crosses the threshold where it's contributing more than you are in an average year. That moment, the moment your investments earn more in a year than you contribute, is genuinely one of the most profound psychological shifts in the entire wealth building experience, because for the first time, you are not the primary engine. You're a co-engine. The market is doing more than you are. And that shift changes how investing feels completely. It stops feeling like a sacrifice. It starts feeling like a system, a machine that's running whether you pay attention to it or not, growing in the background, working while you sleep. The specific dangers of stage 3. Stage 3 has two very specific dangers, and they pull in opposite directions. The first danger is overconfidence. The balance is impressive now. The growth is real. The strategy has clearly worked, and that success can create a feeling that you've figured this out, that you're ready for something more sophisticated, that the boring strategy that got you here was a starting point, not a destination. And so people start experimenting. They add individual stocks. They put a chunk into something more exciting. They try to optimize and get clever. Sometimes it works in the short run. Often it doesn't. And the cost of a bad experiment at $200,000 or $300,000 is dramatically larger than the cost of the same bad experiment at $20,000 because the numbers are bigger and because the time lost to recovery at this stage matters more. The second danger is complacency. The investing is clearly working. The balance is growing fast. And it can feel like you don't need to keep pushing the contribution rate, that the machine is running well enough on its own. But the contribution rate in stage 3 still matters enormously because you're building the base that all future compounding sits on. And every dollar you add to that base in stage 3 generates more long-term compounding than a dollar added in any later stage because it has more time to compound. Staying aggressive about contributions through stage 3, even as the market starts doing more of the work, is what separates people who reach $500,000 quickly from people who get there on a much longer timeline. What stage 3 demands? Stage 3 demands discipline in the face of success. Not discipline in the face of struggle like stage 1. Not resourcefulness in the face of life pressure like stage 2. Discipline in the face of success. The discipline to not get clever when the boring strategy is working. To not experiment with the base when the base is doing exactly what it should. To stay consistent through the feeling of wanting to do something more impressive. The people who navigate stage 3 will arrive at $500,000 with a strategy that's still intact and an identity as an investor that's even stronger than when they started. Stage 4, the acceleration, $500,000 and beyond. Okay, this is where the math becomes almost difficult to believe. At $500,000 invested, the market is generating roughly $50,000 a year in average returns. $50,000 in a year where you didn't do anything differently, where you just stayed the course. That is above the median household income in America. Your portfolio is generating more in an average year than most American households earn from work. At $750,000, it's $75,000 a year. At $1 million, it's $100,000 a year. The numbers become genuinely staggering in stage 4. And the experience of being in stage 4 is completely different from every stage that came before. The financial anxiety that characterizes most of adult financial life is largely gone. Not because you've solved every problem, but because the portfolio is large enough that the worst case scenarios, job loss, unexpected expense, market downturn, are survivable without catastrophe in a way they weren't in earlier stages. The options that weren't available before start to open up. Leaving the job that's making you miserable, taking 6 months to figure something out, starting something without knowing exactly how it'll work financially, moving somewhere that makes more sense for your life, even if it's more expensive. These decisions, which felt risky or impossible in earlier stages, become manageable in stage 4 because the financial foundation underneath them is solid enough to absorb the risk. The specific challenge of stage 4. Stage 4 has one very specific challenge that the earlier stages don't. Volatility at scale. When you have $500,000 invested, a 20% market correction costs you $100,000 on paper. In a matter of months sometimes. When you have $1 million, a 30% correction costs you $300,000. These numbers are disturbing in a way that the same percentage drops earlier in the journey simply aren't. Because early on, the absolute dollar amounts are small enough that you can rationalize them. At stage 4, the absolute dollar amounts are large enough to feel catastrophic, even when the percentage loss is exactly the same as it was in stage 2. And this is where some people who navigated every previous stage successfully make their most costly mistake. They sell at the bottom to stop the pain of watching that much money disappear from their balance. And as we've covered throughout this channel, selling during a correction locks in the loss and misses the recovery, which is the exact wrong sequence. The people who successfully navigate stage 4 are the ones who made peace with volatility early, who built their understanding of how markets work deeply enough that a $200,000 paper loss doesn't feel like a catastrophe, who know that the line goes up over time and that the temporary downs are part of the process. What stage 4 demands? Stage 4 demands something that sounds almost paradoxical: equanimity, calmness, the ability to watch large dollar amounts fluctuate without it affecting your behavior. Not excitement, not panic, just steady, consistent equanimity. The people who have it in stage 4 are almost always the ones who built it in the earlier stages, who practiced staying calm through smaller corrections when the stakes were lower, who developed the understanding and the identity that made the larger fluctuations survivable. You don't suddenly become calm at stage 4 if you weren't building that calmness along the way. Where most people get stuck and why. Okay, so let's be very direct about the statistics here because I think they're important and sobering. Most people never make it past stage 1. Not because stage 1 is impossible. Most incomes are sufficient to get through stage 1 in a few years with consistent effort. But because stage 1 requires sustained, consistent behavior without adequate emotional reward. And humans are not naturally wired for that. We're wired for feedback, for results proportional to effort, for signals that what we're doing is working. Stage 1 doesn't give you those signals. Not clearly. Not quickly enough for the motivation to sustain itself without understanding. And without understanding what stage 1 is supposed to feel like, without knowing that the impatience and frustration and sense that nothing is happening are features of the stage rather than signs that something is wrong, most people interpret those feelings as a signal to stop. So they stop. And then sometimes they start again and stop again. And the years pass and the compounding doesn't happen because the habit never truly took hold. The people who make it through stage 1 are almost always the ones who understood it in advance, who knew what to expect, who had internalized clearly enough why it works that the absence of exciting feedback wasn't enough to derail them. That understanding is what this channel is trying to build, not just in this video, but in everything we've talked about, because information is not enough. You also need to understand what the journey actually feels like so that when you're in the middle of it, you can recognize what stage you're in and what that stage demands, the close. So here's the full picture. Stage 1, $0 to $25,000, the foundation, where the habit gets built, where most people quit, demands consistent behavior in the absence of emotional reward. Stage 2, $25,000 to $100,000, the grind, where life applies the most pressure, demands resourcefulness and a refusal to pause. Stage 3, $100,000 to $500,000, the tipping point, where the math starts doing more than you are, demands discipline in the face of success and a refusal to get clever. Stage 4, $500,000 and beyond, the acceleration, where the numbers become genuinely life-changing, demands equanimity in the face of large dollar volatility. 4 stages, 4 distinct challenges, 4 completely different psychological experiences, and one common thread running through all of them. The people who make it through each stage are not the ones who had the most talent, or the highest income, or the best timing, or the most sophisticated strategy. They're the ones who understood what each stage demanded, and then they did that thing consistently until they reached the next one. That's the whole path. You just have to decide which stage you're going to get stuck in, or whether you're going to get stuck at all.